It's time to get technical on the markets, and joining us is Ron William. He's founder and principal market strategist at RW Market Advisory. Ron, good to see you, even if you are in Switzerland as opposed to here in the studio as usual. Let's talk about the S&P 500. I had a technical analyst yesterday who was indicating that we're going to see higher highs on the S&P 500. Would you agree with this?
Well, Happy New Year greetings from Switzerland, Louisa. Nice to be back. On the S&P 500, yes, I mean, we're still extending that relief rally after the optimistic fiscal deal, supposed deal. And now the key thing that you just highlighted there is the lofty heights that we're in on the S&P 500. If we take a look at those crisis peaks at 2007, around 1576, just as your guest just mentioned. So at these levels, I mean, the risk reward is fairly poor to add further long positions, and it's probably a good time to maybe start to unwind some positioning. And certainly we are seeing that if we look at insider capital flows, actually at record short positions, last seen I think in 3.5 years ago, so record short positions on insider flows.
This is John Authors. If I could ask one follow-up question. If we were to take that chart back a little earlier, it would look as though we'd had one giant double top for the peaks in 2000 and 2007. How important is the notion of a triple top if we get there? How clearly do we need to breach the all-time highs before a technical analyst would think that we had finally got beyond that ceiling that we established in 2000 and 2007?
It's a great question, and these days in these markets it's good to have strong price and time filters, and so in price terms you really need to see a weekly or monthly close above the 2007 high. But the second thing I would add to that is the time side of things, and keep in mind that the actual what I'm calling a bear market rally from 2009 is very overextended. It's on borrowed time, and so even if we were to break above the 2007 peak, the key point here is we've been on this bear market rally for too long, and probably require a healthy pullback for that to really be a meaningful push above the 2007 peak.
Ron, let's just move on and talk about the dollar-yen next, because we saw the Bank of Japan's announcements coming out overnight and kind of not pleasing the market. The market thought that we'd be getting more in terms of both stimulus, and also the time frame is first 2014. So what's the play on dollar-yen now?
Well, it's clearly that it's still the hot topic, especially dollar yen up around 17% from its lows from autumn of last year. And I mean, to supplement the fundamental factors that you mentioned, the BOJ meeting, of course on the technical side, that there's a flurry of overbought kind of exhaustion signals, and I've just highlighted there at the market exhaustion signal, which also coincides with that psychological level at 90 last seen in 2010. So certainly this is a good area for a lot of investors and traders out there to take some temporary profit taking and maybe reload for further long positions later on. But the actual trend itself is looking very overextended at around these 90 psychological levels, and it's likely to have a pullback before we see further upside.
Ron, good to see you. Thank you very much. Ron William, founder and principal market strategist from RW Market Advisory.